Imagine waking up tomorrow, swiping your debit card to buy a coffee, and finding out your entire bank account is totally frozen until you can physically prove you are a U.S. citizen.
I mean, yeah, it is definitely a jarring scenario, especially since, we've all just grown so used to our money just being there,
Hmm.
humming away in the background.
Right. When we think of banking, we just think of the basics. You deposit money, you withdraw it, maybe you get annoyed by a random ATM fee.
Exactly, the simple stuff.
But over the last few days, a massive story has been building that could literally rewrite the fundamental rules of who is legally allowed to hold a bank account in the United States.
It's a huge shift.
So here is the hook. We are looking at a drafted executive order from the Trump administration, and it's being spearheaded by Treasury Secretary Scott Bessent.
Huh.
If this drops, it will require banks to collect hard, documentary proof of citizenship from you, your family, and everyone else.
Right, and the craziest part is they don't just want this for opening a new checking account. They want to retroactively apply this to existing accounts, too.
Which is wild. So today, our mission for this deep dive is to completely unpack this proposed shift. We are pulling from a massive stack of reporting to get the full picture today.
Yeah, we've got a lot of ground to cover.
We do. We're looking at Axios, the Wall Street Journal, Semaphore, the Economic Times. Plus, we've got hard numbers from think tanks like the American Action Forum and quotes straight from Secretary Bessent himself.
It is a mountain of data, but it paints a very clear picture of where things are heading.
It really does. But before we dive in, I want to make something crystal clear to you, the listener, because today's deep dive involves highly politically charged topics, specifically the Trump administration and immigration policy. We are leaving all personal politics completely at the door.
Yep, absolutely.
We are entirely impartial here. We are not taking any sides, and we are not endorsing any specific viewpoints. Our sole purpose is to impartially report and analyze the ideas, the facts, and the mechanics contained in our source material.
Nothing more, nothing less, just the mechanics of the policy and, its real-world impacts.
Okay, so let's unpack this. We all know the standard, know your customer, or KYC drill.
Right, the identity checks.
Yeah. Since the Patriot Act passed, banks have needed your social security number, your date of birth, and your address just to prevent money laundering. But they've never actually cared about seeing your passport.
No, they haven't. And what's fascinating here is the underlying philosophy of the administration on this. You're right. Current KYC laws establish identity. They prove you are who you say you are.
Right.
But Secretary Bessent and the administration argue that mere identity verification leaves this massive blind spot regarding legal status.
It's a totally different thing.
Exactly. At a recent Semaphore event, Bessent basically said that undocumented immigrants don't have a right to participate in the U.S. banking system. He asked this very direct question. He said, why don't we have information on who's in our banking system?
So currently, opening an account is like a bouncer checking your ID at the door of a club just to make sure you're 21.
Right, a basic age check.
But this new rule is like the bouncer demanding a full genealogical background check before letting you buy a drink. But wait, if they already have your social security number or your individual taxpayer identification number, isn't that enough to stop financial fraud?
Well, the administration's counterargument is that stopping individual fraud just isn't the only goal anymore. They are actively trying to merge immigration enforcement directly into the domestic financial engine.
Wow, so combining the two.
Yeah, their logic is pretty straightforward, actually. If you control access to the financial system, you control who can comfortably live, work, and transact within the country's borders. It's really a tool of deterrence.
So it's using the banking sector as a literal enforcement arm. But flipping the switch on a rule like this isn't just a minor policy tweak. It sounds like a massive operational earthquake for the banks themselves.
Oh, the logistics are incredibly heavy. We're talking about a fundamental rewiring of how banks onboard every single customer.
I was looking at the numbers from the American Action Forum, and their projections are just staggering. Let's look at their stats. They estimate this rule will add a collective 33.1 million to 73.3 million hours of paperwork to the banking sector.
That is just a tsunami of paperwork.
Right. And they project it will drain between $2.6 billion and $5.6 billion from the banking industry in compliance costs.
It is a massive financial hit.
But honestly, in 2026, where banking is entirely digital, I have to push back a little here. Why is this so expensive? I mean, we have all these instant digital tools. Can an algorithm just check a box somewhere in a federal database?
You'd really think so, but The architecture of legacy banking systems just doesn't work that way. Citizenship verification requires specific, physical, or highly verified documentary proof.
So a digital scan isn't enough.
No, we're talking about naturalization certificates, passports, or certified birth certificates. A digital algorithm can't just scrape your credit score and guess your citizenship status.
Because citizenship isn't just a data point. It's a very specific legal status attached to a physical piece of paper.
Precisely. And banks currently run on decades-old core processing systems. Sometimes it is ancient code. Their digital infrastructure is built to cross-reference a 9-digit social security number with a credit bureau.
Right. Simple text data.
Exactly. It is absolutely not built to securely ingest, analyze, optically read, and then permanently store millions of high-resolution images of passports. They would literally have to build entirely new, heavily encrypted database architectures.
Just to hold this documentation without creating a massive cybersecurity risk.
Exactly.
But here's where it gets really interesting. That multi-billion-dollar estimate mostly covers new accounts. But the reporting shows this executive order could force banks to re-verify millions of existing account holders.
And that is exactly where the operational friction turns into a total firestorm. Imagine a bank with 50 million existing retail customers. They now have to email, mail, and call every single one of them, demanding physical documents. And if you don't produce them in time, the bank might be legally required to restrict your access, freeze your funds, or just close your account entirely.
Which means the burden doesn't just fall on the banks. The burden falling on everyday consumers is even heavier. Because let's be real, tracking down those specific pieces of paper is not just a quick afternoon errand for a lot of people.
It is a huge hurdle. Let's look at the documentation gap here.
Yeah, I have the stats right here, actually. Out of over 340 million Americans, there are only about 183 million valid passports in circulation. So nearly half the country doesn't even have a passport to start with.
Right, that is a massive chunk of the population.
And on top of that, an estimated 21 million voting-eligible citizens don't have ready access to documentary proof of citizenship. Like maybe their birth certificate was lost in a fire, or they just, never needed to order a certified copy.
So that's a huge segment of the population completely exposed to losing their banking access.
But wait, I have a question about this. What about a real ID? Everyone has been forced to go to the DMV and get those updated driver's licenses with a little star on them. I had to bring my birth certificate to the DMV to get mine.
A lot of people did.
So can't the bank just scan my real ID and assume the state already did the vetting?
It's a really logical assumption, but the reports explicitly state that standard real IDs would not be accepted as valid documentation under this proposal.
Wait, why? If the DMV already checked my birth certificate, why doesn't the ID count?
Well, because a real ID establishes your identity and your legal, lawful residence in a particular state. It does not definitively establish U.S. citizenship.
Oh, I see.
Yeah, legal permanent residents, green card holders, they can get a real ID. Temporary visa holders can sometimes get them too. So legally speaking, a bank cannot look at a real ID and definitively prove you are a citizen.
Oh, man.
Yeah.
So you truly need the actual passport or the birth certificate in your hand. Who gets hurt the most by a requirement that strict?
Well, it disproportionately threatens vulnerable native-born U.S. citizens. Think about, elderly Americans born in rural areas 80 years ago, way before hospitals kept standardized digital birth records.
Right.
Or low-income populations who simply can't afford to take time off work or pay the administrative fees to navigate steep bureaucracies just to replace lost documents. Currently, about 5% of U.S. households are unbanked. If this policy drops, experts warn that number could just skyrocket overnight.
So millions of actual legal U.S. citizens could be debanked just because of a paperwork bottleneck. That's wild. But then there's the other side of this too, right? The impact on non-citizens.
Yes, that is a whole other layer.
Because right now, many non-citizens are legally paying taxes using an ITNN. They use standard bank accounts to deposit paychecks, pay rent, and buy groceries. If they get kicked out, they don't just vanish into thin air.
No, they don't. They get pushed completely into a cash-based shadow economy, and the economic multiplier effect of that is severely negative.
Walk me through that mechanism. How does a shadow economy actually hurt the broader system?
Okay, so when millions of people operate entirely in untraceable cash, it literally starves the formal economy of capital. Those individuals can't get auto loans, they can't get mortgages, and it becomes incredibly difficult for them to pay standard income taxes.
Right, because it's all off the books.
Exactly. Beyond that, it shifts financial activity into unregulated channels. Think predatory check cashing places or underground lending networks. And the irony here is the very money laundering that our KYC laws were originally designed to prevent, that actually becomes significantly easier when millions of people are forced to transact entirely off the grid.
That is a wild unintended consequence, which kind of leads me to the legality of all this. If we're talking about a policy that could cost banks billions, freeze citizen accounts, and spawn a massive shadow economy, does the president actually have the legal power to just sign a piece of paper and force this through?
That is exactly the legal minefield the administration is about to walk right into. The consensus from legal experts and groups like the National Consumer Law Center is that a simple stroke of the pen executive order would likely exceed presidential authority.
Because of existing privacy laws, right?
Exactly. Specifically, the Right to Financial Privacy Act. This act establishes a baseline legal rule that the federal government cannot simply demand sweeping financial records from a bank without a valid legal reason, like a targeted subpoena.
So they can't just go fishing.
Right. They can't just arbitrarily deputize the banks to become an arm of immigration enforcement.
So if a direct executive order is illegal, how could the administration actually force this through the system?
They would almost certainly have to use the Administrative Procedure Act, which is known as the APA.
Okay, I know the APA is how federal agencies change regulations, but how does that actually work in practice for something like this?
It is an incredibly grueling, highly structured process. Under the APA, an agency can't just declare a new rule and walk away. They have to formally propose it, open it up for public comment for months, and provide rigorous economic impact analyses.
Which sounds like it takes forever.
It does. And most importantly, the final rule cannot be deemed arbitrary and capricious by a court.
Okay, so if the big banks take the administration to court and they can mathematically prove that this rule cost them $5 billion, disrupts millions of legal citizens, and catches almost zero actual financial criminals, a federal judge could just toss the whole rule out for being arbitrary.
That is a very real possibility. It usually takes 1 to 2 years just to finalize an APA rule, and even then it is an absolute magnet for litigation. Banks have massive, incredibly well-funded legal teams.
Yeah, they do.
They've previously sued agencies like the Consumer Financial Protection Bureau over APA regulatory changes, and the banks won.
Which totally explains why even Republican lawmakers see the vulnerability here. Senator Tom Cotton from Arkansas recently introduced a bill that would mandate these exact citizenship checks, but he explicitly wants to do it through Congress.
Right.
He clearly recognizes that passing actual legislation is the only bulletproof way to make this policy survive a court challenge.
Yeah, he sees the legal writing on the wall. But if we connect this to the bigger picture, you can see the administration is already moving other regulatory chess pieces to prepare the ground for this shift.
What do you mean? What else are they doing right now?
Well, the Consumer Financial Protection Bureau and the Department of Justice are currently withdrawing a specific guidance document from 2023. That previous guidance explicitly warned banks that they risked violating the Equal Credit Opportunity Act if they used immigration status to determine a consumer's creditworthiness.
Oh, wow. So by withdrawing that guidance, they're essentially giving banks the green light to factor immigration status into whether or not someone gets a loan or a credit card.
It is a massive signal. It demonstrates a total philosophical shift in how federal agencies view the intersection of finance and immigration. That historical firewall between the two is just being systematically dismantled.
It really is fascinating. But let's zoom out for a second, because this aggressive domestic restructuring of the banking sector is happening while Treasury Secretary Bessent is simultaneously trying to manage massive global economic shifts.
Right. He has a lot on his plate.
He is juggling a banking overhaul, global wars, and inflation, all at the exact same time.
His mandate right now is incredibly broad, and, the macroeconomic environment is really fragile.
Let's talk about that macro canvas. In his Semaphore interview, Bessent spent a lot of time on the war in Iran and U.S. inflation. We just saw a really bad inflation report. Prices are clearly rising again. But Bessent stood up there and boldly claimed he believes this inflation is truly transitory.
Transitory is a very dangerous word in economics right now. The Federal Reserve got burned badly using that exact word just a couple of years ago.
He didn't shy away from it, though. He argued the Fed needs to wait and see before lowering interest rates, pointing out that despite the recent bad numbers, the underlying U.S. economy is structurally strong.
It's a bold stance.
It is. But I have to ask you to connect these dots for me. We just spent all this time talking about a domestic policy that will actively disrupt millions of bank accounts and cost billions. Now we're talking about fighting global inflation and managing supply chain shocks from a Middle Eastern war. How do these wildly different pieces fit together in Bessent's mind?
It all really comes down to two foundational themes for this administration: resilience and risk management.
So it's about prioritizing strict security over a smoothly running system.
Exactly. For decades, the global economy was built on frictionless commerce. Make it as cheap and easy as possible to trade goods and move money around.
Just keep things moving.
Right. But Bessent looks at the world and sees that frictionless system as just full of vulnerabilities. In the Middle East, he argues the Iran war shattered the illusion of security regarding global oil supplies. Regarding China, he points out they aren't a reliable partner for rare earth minerals, so we have to endure the pain of onshoring supply chains.
So bring it all back home.
Yes. And domestically, he looks at the banking system and sees an open door. He wants to know exactly who is inside the house.
So the unifying theory is that they're willing to intentionally cause economic pain, whether that's higher prices from tariffs or billions in banking compliance costs, if it means gaining tighter, hardline security.
You nailed it. And nothing illustrates this hyper-focus on security better than their approach to the cyber threat, specifically regarding artificial intelligence.
Yes. This was the detail in the reporting that completely blew my mind. Bessent recently summoned major bank CEOs to his office. But they weren't talking about interest rates or citizenship proofs. They were specifically briefed on the cybersecurity risks of large language models.
It's a huge pivot.
They specifically talked about a new AI developed by Anthropic called Mythos.
Yeah, Mythos represents a total paradigm shift in cyber capabilities.
Explain the mechanism there. How does an AI chatbot actually threaten a major bank?
Well, it's not a chatbot in the traditional sense at all. Mythos is highly advanced at understanding and manipulating complex code environments. The fear isn't just that it can write a tricky phishing email.
Right.
The real fear is that it can autonomously map out the interconnected APIs of the global financial system, read through that legacy banking code we talked about earlier, and instantly write zero-day exploit code to breach those systems, and do it at a scale human hackers couldn't possibly match.
So it is basically a highly autonomous, infinitely scalable superweapon for finding the weak points in a bank's digital armor.
Essentially, yes.
And you have the Treasury Secretary personally bringing in top bankers to say, you need to build a fortress against this right now. It really shows how laser-focused they are on systemic vulnerabilities, whether it's a physical border, a supply chain in the Gulf, or the digital code running a Wall Street mainframe. They are just hunting for weak points.
But this raises a vital overarching question, right? The administration is aggressively building fortresses on all fronts. They're locking down global trade. They're demanding physical citizenship proof at local banks. They're preparing for AI cyber sieges. But does building all these fortresses inadvertently choke the very economic growth they are trying to protect?
It's the classic trade-off. If you make it incredibly difficult to open a bank account, or you heavily restrict global trade just to punish bad actors, you inevitably throw sand into the gears of the whole economic machine.
Yeah, security always demands a sacrifice in efficiency. The administration firmly believes the sacrifice is worth it to build national resilience. Critics, on the other hand, argue it's going to cause unprecedented chaos for everyday consumers.
So what does this all mean? Let's bring it right back to you, the listener. We started this deep dive talking about the most basic expectation of banking. You put your money in, you take your money out.
The absolute basics.
But if this executive order actually moves forward, the simple act of holding a checking account might soon require a frantic treasure hunt through your attic for a birth certificate or a valid passport. It fundamentally alters the relationship between you, your assets, and the government.
It really does.
Ask yourself, if your bank suddenly froze your checking account tomorrow morning, how easily could you prove your legal citizenship? Do you actually know exactly where your original birth certificate is right now?
It is a logistical question millions of Americans might have to answer much sooner than they think. And before we wrap, I want to leave you with one final, slightly provocative thought experiment to mull over.
Okay, let's hear it.
We talked extensively about how this policy could push millions of people out of the traditional banking system and into an untraceable, cash-based shadow economy.
Right, people shifting to cash just to survive day to day.
Exactly. But historically, sovereign governments absolutely hate untraceable money. It limits their ability to collect taxes and monitor illicit activity. So if millions of people successfully move into the shadows to avoid these new citizenship checks, How does the government respond?
Oh, I see where you're going.
Could this massive disruption actually accelerate the push toward a central bank digital currency, or a CBDC? Think about it. If physical cash suddenly becomes the primary tool for subverting the state's security goals, a fully traceable digital dollar would solve the government's problem overnight.
Wow.
A CBDC would allow the federal government to directly monitor and control the exact financial transactions this banking policy was originally trying to capture.
That is wild. You try to squeeze the system closed in one area, and the resulting pressure forces a massive dystopian technological leap in another area entirely.
Yeah.
The ultimate tool for tracking every single dollar in real time. That is definitely a ripple effect we will need to keep a close eye on. Well, thank you so much for joining us on this deep dive. Keep your documents safe, keep questioning the complex systems around you, and we will catch you next time.